Welcome back to our monthly market update for August. If you've been watching through the news or scrolling through YouTube lately, you might think the housing market is about to collapse. But what the mainstream media is completely missing is the fundamental economic floor sitting right beneath our feet, and that's replacement costs. Across the country, dwelling values fell 0.7% in July. However, the variable most commentators are ignoring is the cost of building a replacement house in Victoria is up more than 35% since COVID and rose another 2% in the June quarter alone. When delivering a new build becomes far more expensive than buying an existing home, construction slows down, supply tightens, and buyers are redirected straight back into established housing. This places a firm limit on how far prices can actually fall, and that resilience is playing out in real-time data across our group. Across Victoria, the Ray White network listed just over 1,700 properties in July and sold just over 1,400 homes. While slightly down on last year's record surge, this is right on par with 2024 levels, confirming the market is simply normalizing rather than collapsing. We welcomed over 30,000 buyers through our state open homes in July, up from June. Meanwhile, active bidders per auction jumped from 1.8 to 2.3 over the last 30 days, driving our weekend clearance rate to a healthy 59.5%. Locally, our sales team had a fantastic July, matching our record performance from last July and coming in 18.7% above our 5-year July average. We achieved a 64% local auction clearance rate, while buy attendance at our local open homes rose 8.8% month on month. The buyer urgency has carried right into August. We're currently 11 days into the month and have 22 homes already under offer as buyers rush to secure properties before yesterday's August 10 self-managed super fund borrowing deadline. Looking across our rental department, we've seen rents continue to rise to an average of $564 per week, which is up 6.3% year on year. An interesting observation was an 82% increase in the number of rental providers pulling the pin and selling their investment in the first half of the year compared to the 6 months prior. We fully expect rents to push even higher, driven by a massive spike in rental providers prepping to sell and issuing notice to vacates over the past 60 days in direct response to the recent federal budget changes. The reality is the pool of available rentals is only going to shrink further into the second half of the year as more investors offload their properties. It's opening up a fantastic window of opportunity for first home buyers to get their foot in the door without competing against heavy investor activity. Because of this shift, we're likely to see the proportion of owner-occupied homes increase versus rented properties across the Frankston area over the next couple of years. The bottom line, while policy changes are shifting buyer behaviour, local demand combined with those soaring replacement costs is keeping our market grounded and active. Make sure you subscribe and stay tuned to our channel for our upcoming suburb by suburb updates where we break down the exact numbers for your specific area. If you want to take advantage of these balanced winter selling conditions, hit the link in our bio to book your free property appraisal today or get in touch with one of our local agents today. Thanks for watching. I'm Ash Weston. I'll see you at our next market update.